Hello everyone, welcome back to a new video here on activities. Today in this video we're going to value meta platforms, or at least we're going to try to value meta platforms after the most recent fiscal year 2024 earnings report. So we're going to look at the fair value of this company, so we're going to take a look at the CFO outlook, some guidance that they gave for this year. Let me just start the video off with, wow, what a performance Meta reported. $8 per share in EPS. It's just crazy. A crazy 20% earnings beat. Overall, the numbers look very strong. I have to say that. It's just absolutely stellar how good this company is at just performing and making money. Let's just put it that way. They're just making money. So we want to look at the fiscal year guidance for fiscal year 2025. So what I first did is just look at the CFO outlook and some guidance that they give. So the midpoint for revenue in quarter 1 2025 is $40.5 billion. The rest of the quarters they do not give in this report. They only give the revenue for quarter 1, and they give the total yearly expenses for 2025 that is expected. So this is the guidance that they gave for the first quarter, and I just took the midpoint of revenue growth that they gave for this number, which is between 11 and 18% on a constant currency basis. That's about 15%, and just applied that to all the previous quarters, right? To the quarters of the previous years. Applied that 15% growth, and that's how we got this revenue. So an estimated revenue of about 190 billion in fiscal year 2025. Current 12 months ended revenue of 2024 is 164 billion, so that indicates about a $25 billion growth, right? Overall pretty decent, which would be about 15%. So here we got the COGS, which is just basically, we're just estimating that it will be staying the same over the year. So we just took the previous COGS, divided that by the total revenue, and then applied that ratio to, or that multiple, however you want to call it, or a factor I should actually say, to this revenue, and we got the COGS, right? COGS tends to be somewhat in line with revenue, so that's just how we calculated it. Then we got the gross profit per quarter, per annum basis, about 150 billion. SG&A about 4 billion. We're expecting that not to really grow, right? I mean, overall, SG&A is expected to stay relatively the same. Now, research and development, I don't know exactly how this works in Meta, but every quarter tends to be, in quarter 1 tends to be the lowest, and then quarter 4 tends to be the highest for some reason. I don't exactly know the reason for that, but overall we just went from 10 to 11 to 12 and 12 billion. Total is 45 billion expected. SG&A is about 16 billion. Mind you, these are not the numbers of CFO. These are the numbers I calculated and I put into the formula. The only number the CFO gave is the total outlook, which is between 114 and 119 billion, and our calculation is right in that range. So operating income comes down at 92 billion per fiscal year, or for quarter 1 is about 19 billion. Interest is about 200 million in income. This is a negative, but this is an interest net income, okay? So we're adding that to the number. And taxes is expected to be between 11 and 15%, so we took the midpoint of 13.5. Then we get net income of $80 billion. Add back the depreciation, which is $23 billion, and we get a rough estimation of operating cash flow, okay? Because after all, depreciation is an expense, but it's not a cash expense, right? It's just on a GAAP or an accounting expense, right? Total expense for the year, 118 billion, which is just below the max range of 119 billion. A net income of 80 billion. Current net income is 62 billion, so you can already see that it's quite a decent growth still. It's about a 33% growth in net income. Still looks very good. Then we calculated the WACC. We got the market value estimation, so we just take the shares numbers for the equity portion times the share price. This is, by the way, the wrong share price, but 690. Doesn't really matter because it put in the equity value here anyways, the market cap. Okay, I don't know what the market cap is right now. Maybe I should update that. Let me just look real quick. 1.7. That's not very good. Let me just update real quick. So, and we got current liabilities, and this is just a well, just the liabilities with the AAA corporate debt rating. I've also tried to estimate the market value according to the bond market price formula, right? The bond valuation formula. You get roughly the same, okay? So we're not gonna mess too much with that. Just took the debt value. As you can see, it's mostly fueled with equity, of course, because after all, that's what's just made the craziest increase in the recent years. The beta is actually 1.22, but I put it on 1 because I think otherwise you get a way too heavy whack. If you put in 1.22, we get a whack of 10.9, and that's very steep. That's a very steep whack. So a 1, and we get a whack of 9.75%, which is already quite high. Okay, that's already quite a high weighted average cost of capital. So, but we're just taking that part. I'm going to go to cash flows. Of course, the WACC, by the way, the equity part is calculated with a CAPM model. So just take the market return average of 10%. The beta, you would normally take that. And the risk-free rate, which is about 4.57%, it is hovering somewhere in that range. You get now a required rate of return of 10% because we got a beta of 1. So basically what it would say is like right now you would, for a stock that has the risk, because beta is the quantitative measure of risk, because the beta of the market is also 1, we would at least want a required rate of return of 10%, aka equal to the markets, right? So this is how do you say that? It is a formula which you could definitely debate upon whether that is an accurate measure, in my opinion. Given that the market rate is a big assumption, the beta is a bit skewed, because is it really a way to determine risk? Risk-free rate is of course whatever it is, but so these two, if you take the market return of the last 5 years, then we would have a way higher percentage than the 10%. The beta is also an historical average, so it's a bit of an iffy, but we're just taking the 10% market rate, okay? You could also say I'm taking 1.22, and then we're gonna work with that, and that's a possibility. You could do that, but then definitely your price, your fair value assessment is going to be way lower. I can show that later in the video. So we got the cash flows for the next 10 years. So this is the current, right? This is for next year's or fiscal year 2025 guidance, up about 13.5%. After that, every year we're going to anticipate 14% operational cash flow growth. And after that, fifth year, we're going to anticipate about 10% operational cash flow growth. Take that for how much you want. Okay, this is just all estimations. You could also say like, okay, it's going to grow 5% after these 5 years. I just think that going from 14% to 5% is quite steep. Also, this seems to be backed by some analysts. Seeking Alpha, for example, even says 16.8% per year. Now, I think that's really dubious. If we're going to grow next year with 13.5 and then the second year with 16.8 and 16.8, 16.8, that's a bit of a dubious growth rate. So I decided to go with 14%. Also seems to be somewhat, the EPS analysts forecast seems to be about 12%. Now, since the majority, or no, not the majority, but a big part of the additional costs in next year are going to be depreciation expenses, those are going to grow a lot. I would say that operational cash flow, since you add back the depreciation, it's very likely to grow a little bit faster, a little bit more than EPS, right? And after that, we're going with 10%. Just an estimation, just an assumption. You could plug in any number you want there, really. You could also say, okay, well, it's not going to continue on growing forever at 10%, so we're going to take 5, 3, 2, 1, and then, or take it at 3% and do say like it's going to grow at GDP rate. CapEx, of course, this was this year. This is the anticipated CapEx of next year. I think everybody kind of knows that about Meta now. And we're expecting 5% CapEx growth. The reason for that is, normally you would say like, oh, that's going to grow very quick because Meta is investing a whole lot. But I think the steep step from 37 to 65 already makes it so that CapEx is unlikely to continue on growing much, much more. It could be. It could continue on growing at 10, 12, even 20%. But I doubt whether that is actually going to happen. So we're just taking a little bit conservatively here with 5%. Or actually, you could also say in valuation terms a little bit liberally. Discounting factor, of course, and we get a total discounted free cash flow of 500 billion. Okay, about 600 billion actually. Perpetuity growth model to value the company, right? To value the terminal value of the company. We get a 10-year cash flow, apply the 10% growth rate to that, we get 199 billion in free cash flow. Discounting factor of 11 years. We get free cash flow discounted, and we get the total company value according to the perpetuity growth value. We get to the $1 trillion value in terminal value, according to the perpetuity growth value formula. Well, so of course now the moment we've all been waiting for, the company value, cash flow value, add these two together, discounted values, we get total value of 1.6 trillion. Divided by the number of shares, we get a fair value share price of $625, which is significantly lower than the current $690. Now, the reason why that is because the variance in this is enormous, okay? If we say, for example, it's gonna grow the cash flow at 16% over here, or well, this year really, because fiscal year 2025 is pretty much already set, 16.8%, we're gonna get more or less like $700 in fair value, okay? Now, if we apply the WACC and we actually make this 1.22, that's going to be atrocious. We're going to get a very, very bad company value of $515, okay? Which I think is so low, actually, that it makes no sense. I also think that 10.9% in WACC is way too steep. Like, that's way too much. So I think a 9.75% WACC is quite good. It's an accurate representation. Fair value share price 625. Do with that whatever you want. Once again, the formulas are what they are. The input, the data which you input, that is of course the most important part. Remember, trash in equals trash out. So the fiscal year 25 guidance actually looks pretty darn fair. It looks quite realistic. It's a medium case. This is not a bull case. It's also not a bearish case though. Okay, I have been quite liberal in my interpretations, in my cost assessment, and also definitely in the revenue growth. Okay, because it's on a constant currency basis. Now, if we're doing it on a non-constant currency basis, it's going to be even lower. So it's not like I've been extremely harsh on the stock. It's also not like I've been extremely easy on the stock either. Now the WACC, you could say that's maybe a little bit steep, but once again, this is just the market values, right? And that is what you take. So you take the market values and then take the CAPM, required rate of return. That's just what we apply to it. The cash flows, this is definitely a part that's highly discussable, right? You can definitely argue about this. Some people might even say like, okay, what's unrealistic that this is going to go with 10% each year. Fair enough. Also very possible. Some people might say, no, I think that Mark Zuckerberg is going to grow and keep on growing CapEx expenditure. Also very possible. There are also some people that might say, well, according to the fact that they're investing so much in AI, they're going to get the best model and they're going to return so much shareholder value with that. They're going to turn in way more than the 14%. Okay, that's just you. That's your calculations. This is just what I could have found online about analysts, and this is also just some what I personally expect that's going to happen, and what is decently realistic, right? Property group. This is just what it is. Not much. It's not much you can debate about this model, really. So $625. That's just the thing. Okay, and that means it's basically overvalued by about 10% right now. So that is my fair value estimate of Meta platforms. Now, once again, keep in mind this is absolutely in no way, shape, or form any investment advice. I'm not a licensed financial advisor and all that stuff. So do it as information what you want, but don't use it to base your investment thesis on. I would absolutely recommend all of you to assess these companies for yourself and look at their earnings, look at their guidance, look at the reports, and based upon that make a fair value assessment. But this is simply just a number that I come to, and I feel like this is a pretty realistic number. But then again, of course, remember, garbage in is garbage out, and of course, it's in no shape or form it's something you can point to and say this is a 100% accurate indicator, because that's simply just not the truth. After all, it's all based on assumptions. It's what we think is going to happen and not what is going to happen, right? It's just an assumption, what we assume will happen. Anyhow, I'd like to thank you guys very much for watching. If you found this video helpful, insightful, informative, whatever, please leave a like, consider subscribing to the channel, and well, hopefully I'll see you guys in another video. Thank you very much.